Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Jonathan Barr. Welcome to the show, Jonathan.
Thank you for having me.
Yeah, Jonathan started in acquisitions of single-family higher-end flips and eventually got into ground-up developments and repositioning of multifamily buildings. He is a co-CEO with his brother of JB2 Investments, which is a boutique real estate firm specializing in acquiring, repositioning, and stabilizing multifamily property. They came from a very successful flip business that over a period of 10 years created $22 million in profits with an average return of 38% over 400 deals. Well, congratulations on that. And I want to say too, just so the listeners know, we were going to, Jonathan has some thoughts on just like why holding properties forever, should be the goal and what things around that. I'm looking forward to diving into that and many other techniques that he has for how he's meeting so many investors right now. So Jonathan, welcome to the show. Give us a little more about maybe your focus right now in real estate business and let's jump in.
Sure. So I could start by giving a little bit more background on me. So we started after the last recession. I grew up in a family business. So I joined my parents' business because they had lost a lot of money after the last recession, graduated from college, couldn't find a job in 2008, obviously. And so I joined the team and we went to the foreclosure auctions where we're buying 7-8 properties a month, which was pretty crazy. When there were actually good deals and there were a lot of REOs. And like you said, we built $22 million in profits in that with an average return of 38%. And so in November, bought my first larger multifamily in Kansas City, and then closed 3-4 months ago on the 72 unit behind me that your viewers can't see. But and we actually did have another 69 unit deal in escrow that fell out that we had to cancel because the owner misrepresented the square footages of the units by 25%. So, and they wouldn't budge on price. So we canceled. So basically where we're at right now is we're looking to buy 3-4 deals a year. We put a lot of our own skin in the game and we raise the rest from others that we've been meeting through different means.
Nice. No, I just appreciate you elaborating a little bit there. I know you've got an extensive background in real estate business, and it's interesting. Your family, you grew up in a real estate business, right? And you mentioned, you went through maybe the family went through some hard times, 2008 or before, or different cycles. Maybe you could speak to that a little bit. How did that affect you wanting to be in real estate? And just your business and growth that you've had.
Yeah, I mean, it's always been ingrained in me that real estate is the way to wealth. I mean, it's all that I know. My mom's real estate office was basically my daycare, so I've always been around it. In high school, I even after school to make a little extra money, I'd go and help them out. And that's how I bought my first car. So I've always been around it. And I also, because I saw them take a hit, that's part of the reason the mentality with holding forever, because it brings stability. And no matter what happens in different recessions, if you have enough assets that are cash flowing and they're being maintained well, you could ride through any storm.
Awesome. Well, I'd love for us to jump into that. Just your thought process on why, the goal is to hold forever. I know, there's so many different opinions about that. And I would just love to hear that. And let's jump into why holding forever should be the goal.
Yeah, I think with my background coming from the flip business, the flips are great. We made good money. Sometimes we make 100 a pop, sometimes more, especially in LA where we're doing higher end stuff and people really pay you for design and aesthetics and that kind of thing. And, if you have a property in the Hollywood Hills that's done super nice with an amazing view, there's an untold value there. But you have to keep on we had to find 30, 40 deals a year just to keep the business going. And that's exhausting, number one. And it's getting tougher and tougher to be able to do that. And you make your 100K, give half of it to the government, and then you got to keep on doing that. But if you're holding long term, you're not making those big wins. But if you're invested in 10 different properties and you're making, $1,000 a month on each property, that's $10,000 a month. That's $120,000 a year. So as you see, maybe they're not huge amounts, but they could add up really quick and make a huge impact. And then all the tax incentives that you get from that. The one caveat I would say about holding forever is it might not be forever. It might be 27 and a half years, the time period you have depreciation. So you may need a 1031 into something at that point to keep enjoying the tax benefits of holding real estate. But in the world of syndication and real estate, 27 and a half years, basically forever. So.
Okay. Right. No, that's awesome. Well, I hear this often, or I hear people talk about, like the normal syndication models, usually 5 to 7 years. I know that varies a lot depending on the type of deal and all those things, the listeners hear about and know about. But finding investors that are willing to say, okay, Jonathan, I'm willing to just stay invested for 27 and a half years. How do you find those people? Or I guess tell us about those conversations a little bit. What type of investors are willing to do that?
Yeah. Well, I think the thing with that is usually we're trying to do a refi in year 3 or 4. And so by then we're returning most our capital. So the risk capital is for the most part returned. So most people look at it, if I'm getting most of my money back, I don't really care how long I'm getting a return on something. And yeah, it is a kind of a mindset shift with certain people, and all our like blog posts, all the stuff I put out there, being on podcasts like this, I talk about why, and it attracts that person. Like every investor that I talk to that has read through our information is like, I love what you guys are doing. You guys are looking at things completely different than anyone else. And I haven't seen anyone talk the way that you guys talk. So it is unique, and it makes us stand out because of that. But it does also, it can maybe alienate some people that want to make that quick buck in 5 to 7 years, right? But it's okay. We only need like a handful of people to really continue to do what we're doing.
Yeah, so I would imagine you're getting a lot of more repeat investors that want that like that philosophy.
Yeah, larger checks,
return capital usually. Right.
Yeah.
So what about taking that out over 27 and a half years versus doing a cost seg right away and having that same depreciation in 5 years?
We still do cost segs, and obviously it diminishes the depreciation over that long-term period. But we're hoping with refinances and just increased appreciation, and the idea too is to do multiple refinances. Like in 20 years, you could do 3 refinances and continue to return capital and deploy it in other places. And we could even do a whole nother remodel, 15 years into the deal, Right. We could do a refinance and use half that money to remodel it, bring it up to date, and push rents again. And I mean, holding forever, sometimes if someone brought us an amazing deal, it doesn't mean we won't look at it. We're not going to say no to some incredible deal either, and that we can deploy into maybe a better asset, because that's another part of it too, is as you hold long term, the systems could start to break down. You may need to just sell to get into a better asset, go from a C to a B, and then hold longer term from there. So there's caveats, I guess you could say.
Yeah, of course. Things change, right? Or I mean, we have to be ready to move, no doubt about it. And be willing to pivot sometimes. What about the deal structure and just the return structure, typical return structure for a deal that we are planning to hold forever?
Yeah. So I do project just in that 7 to 10 year period, just because to have some kind of end date to create like some kind of numbers, because it's tough to project 20, 30 years. There's so much, there's so much that could happen between that. So we do need to project on a 7 to 10 year periods. So usually when you start to project into longer periods, the IRR starts to become irrelevant. So we focus more on the cash on cash. So we're trying to hit an average of 8 to 10% cash on cash. And that's kind of what we're putting out there. But we are also always being conservative, especially because of COVID. We're putting higher vacancies. We're bumping up expenses. We're doing that. And it on the last deal we just did, we're beating projections by about 85%. So maybe we're being too conservative. I don't know.
That's pretty significant. No, that's awesome. Yeah, I just appreciate you sharing that. Are there any differences as far as, preferred return, 70-30 split, those things like we would normally hear in a syndication that maybe you might do different in a deal like this?
We keep it super simple, usually around an 80-20 split, 2% acquisition, 1 to 2% acquisition fee, 1 to 2% asset management fee, and no waterfalls, nothing like that. Part of the reason is because we're probably putting $200K to $300K per deal of our own money. So it makes less sense to have waterfalls and all that kind of stuff. Just keeping it simple works.
Yeah. Yeah. No, if you're heavily invested. No. Awesome. Well, what about just ways that you are just reducing expenses even? I know during COVID, that's a big focus of a lot of people, but maybe just some ways that you're changing the operations that to help us think outside the box a little bit to do the same.
Yeah. So the last deal, the 72 unit in Norman, Oklahoma, which is within the metro of Oklahoma City, that was our value add. It was reducing expenses by 25%. So we reduced marketing costs by about $60,000 because they had all these Yelp contracts and like weird contracts that are spending $5,000-$6,000 a month on. So we brought that down just to apartments.com, $300 a month. We brought down insurance costs. They had a bunch of turns, so we haven't had as many turns. So that cost came down significantly. Our manager also manages complexes around this one. So we're able to share staff. So right now I was talking to my regional manager about sharing our manager with another property. So only having a half manager because it's basically stabilized at this point. And she's basically bored and has extra time on her hands. So she could take on 2 complexes. So that's going to cut her payroll, and even we're going to cut expenses even more than we thought just doing that.
Wow. So what a great idea though. After it's stabilized, sharing that manager with another property, even if you gave them a big pay raise, it's still a lot less than paying 2 managers.
Exactly. Yep. And then we have the maintenance person as well. Oh, and then one other thing we did too is there was a pool. And so there was a pool room that was still there. So we're converting that into a studio. So finding little areas we could add units, or even if you have large bedrooms, you could turn them into 2 bedrooms. Large 1 bedrooms, you could turn them into 2 bedrooms and add value that way, just within the square footage of certain units, if the size is there and the layout is correct.
Awesome. Well, what about, I was thinking about that too. I wanted to go back just a little bit. You're talking about just sharing the managers and whatnot. Are you all self-managing or third party? Third party,
but our manager is an operator as well. So he kind of comes from that owner mindset, which we like, and we may even partner with him on future deals as well. So we spoke about that, but didn't want to partner on the first deal we ever did together, of course.
Right.
Yeah.
No, that's awesome. And then I guess before I shift a little bit, I wanted to ask you anything else about just making the case for holding forever versus, I'm sure you get questions about that all the time. Anything else about just why we should really consider holding these deals forever, like you are?
Yeah, because, even if you're on the passive side and you're not doing a lot of work yourself, it still takes a lot of time to vet operators, look at the deal. And the thing about finding the next deal is like, there's always surprises you're not going to anticipate. And why, instead of finding another deal, why not stay in the same deal that really well, and you continue to get money out of it by doing refinances so that you do have money that's not just in the deal, that you could invest in new deals, but essentially you don't have to do as many deals to get the same outcome. And that's kind of the goal. Instead of investing in 50 deals, we could do 25 deals and get the same outcome as doing 50 deals.
No, I think it's a very interesting, claim. Just because I think there's some value there too, that you're not having to worry about the, exiting this deal, how you're going to exit. Can you 1031, or can you make that happen that often?
Yeah.
All those things.
There's so many tax consequences to selling, recapture from all the depreciation that you took from the cost seg. It's like how much money you're going to have left after you pay Uncle Sam after that sale.
So I wanted to pivot just a little bit too, because I know, one of your strengths is like just thinking outside the box, right? And, having that edge that way. And I just wanted you to be able to elaborate a little bit on that and how you've done that.
Yeah. So just with everything, you always need to think, we're in a competitive business. The syndication world, just real estate in general, is super competitive, especially right now as it's fared really well through COVID. Everyone's kind of looking at it as kind of a darling asset. And so you really need to find ways to differentiate yourself. For example, one way is we're hiring a third party to contact owners on our behalf directly. And so hopefully we get better deals that way, and also just more control of the transaction. I feel like a lot of times when brokers are involved, they may not convey your message to the seller as well as you might like. But if you have a direct contact with the owner, you could get in front of them. You could kind of hash it out between the two of you instead of having someone between you that might misrepresent what you say or say it in a way that doesn't mean what you say. So that's one. And then also finding creative ways to find investors. For example, I'm heavily on Twitter. And basically every day I put good value out there, and I've had quite a few people reach out to me that way. And the reason why I jumped on Twitter is because another syndicator I know in LA that did business in the same areas that I did, I went to lunch with him, and he asked me if I was on Twitter, and I was like, no. He's like, well, all my investors come from there. I've raised $20 million off one person I met off Twitter. It's the highest net worth of users out of any of the social media platforms out there. So.
Wow. Well, I want to come back to that, because I think everybody listening is saying, okay, wait a minute. I haven't heard this about Twitter. Everybody hears about LinkedIn all the time, right? But
I hate LinkedIn.
You don't hear that about Twitter. But I wanted to back up a little bit and talk about just how you hired the third party to reach out to owners directly. What is that? Could you elaborate on that process just a little bit? I mean, obviously it's somebody else reaching out on your behalf. So what does that first conversation look like, as far as somebody else calling for you, and how does that process happen to where they're making that connection with you?
Yeah, actually the person we're hiring is kind of putting it out as a service, but they're basically 6 guys cold calling owners. The main guy was a broker for 20 years, kind of like older middle-aged guy. And they have a specific script, and they get to know us, and they mold our story. They also they role play with each other, conversations. They've been practicing our whole script and everything with themselves for a couple of weeks, and we've actually made a list of 300 plus target properties that we want to go after. And we specifically picked them because we wanted like 1970s or newer. There's certain things that we filtered out in different MSAs, and they're just basically going to go after it. And the goal is to get 1 or 2 deals this way this year.
Okay, no, I want to just help the listener think outside the box there a little bit, because just like you are. And maybe we don't need to rely completely on brokers. I mean, that's where we found pretty much all of our deals is on those relationships. However, that's a great avenue, in creating that relationship firsthand, so you can, like you said, gain more control of the transaction. I love that. But before we run out of time, I wanted you to be able to also elaborate on Twitter, and what are you doing on there every day? Like, how are you adding value? What's been the thing that you've done on there that has really attracted the most investors?
Yeah, I'll dig into that. And I wanted to say one other thing about talking to owners directly. We've sent letters and got in contact that way. And believe it or not, texting has been the most successful way to get a hold of people. I think because they like a voicemail, they might not even listen to it, but a text, if it's a short text, they'll at least look at it. And if it's an interesting text, they might respond. Or like a lot of times with the iPhone, you could see if they even read it, right? If they have that setting. So you could be like, oh, I know they saw it. So I could probably try to get a hold of them in some way. But anyway, so your question about Twitter,
is there a way to mass text though, or are you having to sit there and do that? Or?
There is different companies out there that do mass texting, but usually you could narrow down your list pretty, like you can narrow it down to a small amount, but that manually doing it to 50 different owners is not that challenging,
Yeah.
But and then yeah, you just try every means: texting, calling, letters, email. I mean, eventually you get a hold of them. Eventually you might nag them enough that they're going to respond to you. But anyway, so with your question on Twitter, is every day. I even schedule posts sometimes too. Like it has you could schedule posts for a later day. So if I have a good idea, I'll just schedule it for later. But I talk about any challenges that we're encountering so that other people don't have to encounter the same challenges. Like, for example, with the last deal that we just canceled, in due diligence, I found out that it was much smaller than it actually was, just based off what the assessor was showing and the diagrams and stuff that they had. And then I asked the owner, and he realized that he messed up, but then didn't want to budge on the price, so I canceled. And it was an expensive lesson. But I posted kind of a little story about that, and it was probably one of my most responded to posts that I've ever done. So stuff like that. You could also do like kind of little stories, threads where you do a bunch of posts in one. And also talking like I did a post as well of what our experience has been and our successes, and people respond to that really well. And then also throwing a couple events on there that I've done, like Twitter, like Zoom events. So that did pretty well. But yeah, if I look at my CRM and I look at where all the people I'm talking to are coming from, I'd say 80% from there.
Nice. No, I appreciate you sharing that. That's awesome. Cause I love when, people provide other information other than what, we normally hear, which at the moment it's been LinkedIn. But it's so interesting, how Twitter has been most successful for you. And maybe you should, really consider that. But a few final questions, John, what's been the hardest part about just the syndication process or business for you?
I think honestly, raising money has been the most challenge. On the deal behind me, we expected to just raise it from our inner circle because we do know some high net worth people, and a lot of them are in California, and it just couldn't really get their head around investing in Oklahoma out of state. So that was a challenge. A lot of them wanted to see us do like a larger syndicated deal before they invested in the deal. But we knew that we had enough of our own capital to basically do the deal ourselves. So we went into the deal knowing we could get it done regardless of who invested it or not. And now we're actually pretty happy that we're highly invested in the deal because it's performing really well. And we can go back to those people and be like, look, you didn't invest in this, but it's performing 85% better than what we projected. And you would have made 12% return on your money on the first year. So
there you go. Right. Yeah. So maybe they'll be in on the next one now for sure. But yeah, I appreciate you sharing. Just, raising money has been kind of the hardest part. And any other ways that you've got past that difficulty?
Yeah, I mean, I think now I think the sooner you start putting yourself out there and and being on the social media channels and putting out good content and doing an ebook and all that kind of stuff, the sooner you do that, the better off. And the thing too is like it takes time to foster these relationships. You're not going to have one conversation with someone and they're going to invest with you the next day. It takes months for them to feel comfortable with you, to look at the stuff that you're putting out there. So the sooner you start, the more effort you put into that, the more creative, the more of like your heart and soul you pour into those. Like I love to write my blog posts, and I'm starting to get really good feedback on my blog posts, which has been awesome because a lot of times you put stuff out there and you never hear about it. So it's nice to actually hear people saying good things and appreciating what you're putting out there and writing.
Shifting gears a little bit, I like to ask every, just experienced operator like yourself, how do you prepare for a downturn? What do you like to, see? Even as the passive investor listening, I want them to also know how to make sure their operator's prepared for a downturn. But what does that look like for you?
Yeah, I mean, when we look at every deal, we look at what's our break-even point, like how much vacancy or how much economic issues do we need to have before we're even in the red. And usually that's, probably 30 to 40% on most of our deals. So, I mean, basically the country would have to fall apart completely for us to be in that point, or something catastrophic needs to happen. And we usually, we're raising a lot of times all the construction money. So we're not, our loan to cost is usually pretty low. It's in that 65, 70% range, I would say, for the most part. So things have to go really astray. And like I said, we have pretty conservative expense ratios and that kind of stuff. So we're able to usually perform a lot better than we thought. And so we could absorb some pretty big hits if they were to come.
How do you view like reserve budgets?
We like to have at least $1,000 a unit, but if it's a bigger hot value add, probably a couple thousand a unit. But the deals we've been getting into now are mostly stabilized, in pretty good shape properties that just have not been operated well. So we're going in there and just operating them a lot more efficiently and better and more professionally. And like the last deal we ended up canceling on, they don't even market online. Their rent ledger was all by hand. So stuff like that.
Wow.
Yeah.
So John, do you have any predictions for the next 6 to 12 months just in the real estate market?
It's funny, at the beginning of COVID, I would have told you things by now. We'd be seeing all kinds of deals and everything. Quite the opposite is happening. Deals I was looking at a year ago are more expensive today, So will it continue that way? I think as long as, if we get out of COVID or we continue to have stimulus and rates continue to stay super low, it seems like we'll continue to creep up. In the single family space, just because I have some experience there, and I'm actually helping a friend buy a place, and I think there is where things have gone up the most, because everyone wants their COVID house and rents are low and inventory is low. So as long as everything continues the way it is, like I think things will continue to creep up, maybe not as much as they did last year, but you never know. COVID could take a turn for the worst. There could be some other kind of financial crisis that pops up through this that could really affect us. But so it's tough to say, but I would welcome some kind of pain, because I think it would squeeze some opportunities out there. And I got my start during the last recession, where we're buying things at 50 cents to the dollar, and there was all kinds of stuff going on. I don't think we'll ever have that, but I think some kind of, I guess, correction could be healthy, but we'll see.
Do you have any daily habits that you're disciplined about that have helped you achieve success?
I'm all about diet and health, and I go one of my favorite thing to do is I have some really nice trails by my house, and not every day, but at least 2-3 times a week, I'll go and walk, and I'll pop in my earphones and listen to even I've listened to your podcast on some of those walks as well. And or if I have a challenging thing I'm trying to think through, I won't listen to anything, and I'll just kind of let my mind ruminate in the back. And it's where a lot of my creative ideas come from, on those long walks, or even after like a vigorous exercise and have those endorphins flowing, like in the shower. Is when I think of some pretty incredible things. And then also just having time with my family and friends, and making sure to have that. And I think having a really good balance in your life makes you a better investor.
What's the number one thing that's contributed to your success?
I think we kind of touched on it, just looking at things outside the box, pushing through. A lot of times negotiations fall apart like in the last minute, and finding ways to push through that or get what you want out of the negotiation is the differentiator. So finding those little opportunities, and being tough. Like this is also a tough business, and there's ups and downs, and like most of the time it's I would say it's more down, and then eventually you get those good hits that keep you going. But being able to persevere, I think that's another big one, and being able to persevere and have the mental fortitude to be able to do so.
How do you like to give back?
Right now, I actually, a lot of like college kids reach out to me on Twitter. And so jumping on calls with them that want to go down the real estate route, and speaking with them to advise them in a direction that I wish I would have had someone to advise me to go in a certain direction, like buying your first property, buying a duplex, or trying to go as big as you can, at least get to a fourplex. Like I started with buying duplexes that I eventually 1031 10 years later into like the building, the 72 unit behind me. I'm the biggest investor because of a 1031 that I did from a duplex. So all you got to do is start and get that. And also when you're first starting and buying a duplex or a fourplex, you could do a FHA loan and get in there with very little money down and live there and manage it yourself, and really make incredible things happen with just one property.
Awesome. Well, Jonathan, it's been a pleasure to get to know you. I appreciate you listening to the show, but then also being a guest as well. You just laid out a lot of great tips for us today, even thinking through just the buy and hold model. And, we should be considering that, how you've great ways, how you've reduced your expenses. There's a lot of value just in that. And then just thinking outside the box, and then the creative ways through Twitter that you found more investors, and how you prepare for a downturn, so many things. But tell the listeners how they can get in touch with you and learn more about you. Yeah.
You can find me on Twitter at JB2 Investments, or email me at JB2Investments.com. I also have an ebook on my website, the Tax Stack Strategy, just tax strategies. So it's just JB2Investments.com/lower, like lower taxes.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.